Well, the best thing to do is buy a stock that you don't ever want to sell. I mean, that's what we're trying to do.
I would find something that was more attractive, and which I felt I knew as much about, but was more attractive by a significant margin than something I held. So I would sell something I held to buy something more attractive, never to raise cash. And I was always selling things that were still cheap, because it was a market where there were a lot of things that were cheap, and I was looking for the cheapest among things that I understood.
Yeah, when I started out, the self situation has changed over the years, because when I started out, I had way more ideas than money. I mean, I would go through Moody's manual. I went through it page by page, and then I went through it again page by page. And I found stocks in there that I could understand that were selling at like 2 times earnings, even 1 times earnings. Well, when you only have $10,000, that can get a little frustrating. And if you don't like to borrow money, which I never like to borrow money, so I was always coming up with more ideas than I had money. So I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time, I was in that mode. And now our problem is we have more money than ideas. So if you look at our annual report, which is on the internet at our homepage, BerkshireHathaway.com, you'll see something in the back called the Economic Principles of Berkshire. And you will see, which I believe in setting out for my partners. They are my partners. I don't look at them as shareholders. I look at them as partners. They're going to be my partners for life. So I want to tell them how I think. And if they don't agree with the way I think, that's fine. But I don't want them to be disappointed in me. You know. So I lay out there and I say, in terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for. I mean, if somebody offers us 3 times what something is worth, at See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire, because that's the way I want to live my life. I've got all the money I could possibly need.
Well, the best thing to do is buy a stock that you don't ever want to sell. I mean, that's what we're trying to do. And that's true when we buy an entire business. I mean, we've bought all of Geico, or we bought all of See's Candy, or the Buffalo News. We're not buying those to resell. I mean, what we're trying to do is buy a business that we will be happy with if we own it the rest of our lives, and we expect to with those. It's the same principle applies to marketable securities. You get extra options with marketable securities. You can add to holdings, obviously easier. We can never own more than 100% of a business, but if we own 2% of a business and we like it at a given price, we can add and have 4 or 5%. So that's an advantage. Sometimes if we need money to move to another sector, like we did last year, we will trim from some holdings, but that doesn't mean we're negative on those businesses at all. I mean, we think they're wonderful businesses, or we wouldn't own them. And we would sell, if we needed money for other things. The Geico stock that I bought in 1951, I sold in 1952. It was, went on to be worth 100 or more times, before the 1976 problems, 100 or more times what I'd paid. But I didn't have the money to do something else. So you sell if you need money for something else. You may sell if you believe that valuations between different kinds of markets are somewhat out of whack. And we have done a little trimming last year in that matter. But that could well be a mistake. I mean, the real thing to do with a great business is just hang on for dear life.
When to buy. Originally, when I was working with tiny sums, I always had way more ideas than I had money. So I had a portfolio, very limited dollar amount, and I would find something that was more attractive, and which I felt I knew as much about, but was more attractive by a significant margin than something I held. So I would sell something I held to buy something more attractive, never to raise cash. And I was always selling things that were still cheap, because it was a market where there were a lot of things that were cheap, and I was looking for the cheapest among things that I understood. Over the years, as more and more capital is accumulated, for which I'm responsible, frequently money outruns ideas. I have more money than ideas. So now the only reason I would sell something would be if I lost confidence in the business or the management, or it became dramatically overpriced. And That doesn't happen very often. We work with large quantities of stocks, so it's not an easy in and out type proposition. Looking back, you can say that there are some things that I should have sold based on valuation that I didn't sell. There's certainly some things where I've made mistakes about the business, the future economics of the business, and there are a few cases where I've made mistakes about the quality or integrity of the management. But those are the reasons why you sell something.
It's not our natural inclination to sell. And on the other hand, and we have held the Washington Post stock since 1973. I've never sold a share of Berkshire, having bought the first shares in 1962. And we've held Coke stock since 1988. We've held Gillette stock since 1989. Held American Express stock since 1991. We had actually previously been an American Express when, in the 60s in Disney. So there are companies we're familiar with. We generally sell, well, we would sell if we needed money for something else, but that has not been the problem in the last 10 or 15 years. 40 years ago, my sales were all because I found something that I liked even better. I hated to sell what I sold, but I also didn't want to borrow money. But we probably don't think that their competitive advantage is as strong as we might have thought, as we thought it was when we initially made the decision. That may mean that we were wrong when we made the decision originally. It may mean that we're wrong now, and that their strengths are every bit as what they were before. But for one reason or another, we think that the strengths may have been eroded to some degree. A classic case on that would be the newspaper industry generally, for example. I mean, in 1970, if Charlie and I were looking at the newspaper business, we felt it was about as impregnable a franchise as could be found. We still think it's quite a business, but we do not think the franchise in 2002 is the same as it was in 1970. We do not think the franchise of a network television station in 2002 is the same as it was in 1965. And those beliefs change quite gradually, and who knows whether they're precise, whether they're right even, but that is the reason in general that we sell now. If we got into some terribly cheap market, we might sell some things that we thought were cheap to buy something even cheaper after we'd bought lots and lots of equities, but that's not the occasion right now.
I was always coming up with more ideas than I had money, so I had to sell whatever I liked least to buy something new that just was compelling to me.
Well, the best thing to do is buy a stock that you don't ever want to sell. I mean, and that's what we're trying to do.
So I would sell something I held to buy something more attractive.
We generally sell, well, we would sell if we needed money for something else, but that has not been the problem in the last